Hello, my name is Eddie Tofbig. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. As is usual at this time of year, I will stop looking at my daily charts and instead concentrate on the longer term view, using my monthly, even yearly charts to commentate on a market. If you would like to discuss any of these, I'll only too happy to hear from you. So let me now introduce today's longer term chart. Today I'll be looking longer term at ICE Brent crude oil futures. The annual commentary here is still the longest for a third consecutive year, in part because this market was and is difficult to interpret, but also in part because so much has been going on leading up to 2023 through 2023, and that's been by far the quietest year this decade. The first point to highlight is how the action from 2014 created a descending scallop pattern type. The market made a ragged dip in late 2019 and into 2020 before then accelerating higher. A typical move up for such a dip is about a third of the length of the lower ski jump section from the top of the recent highest peak. In this case, the target was in the 116 3/4 area. This was a scenario at the end of 2019. Interestingly, January 2020 started with a huge move lower that penetrated the 2008 to date broken lower descending wedge trend line, currently at 1668, highlighted in dark blue on my monthly chart. But at no point did it close below it. It was from there that we saw the big, long move up, all the way up to and through 116 3/4. I'll now discuss the descending wedge pattern you see. I introduced this idea 3 years ago. The idea of a huge multi-year descending wedge pattern. It was a stretch, but the number of touches on the previously mentioned lower trend line contributed to it, as did the earlier 2+ touches on the upper trend line, currently at 66.87. It was at this point in my explanation of my idea from 2 years ago that I proceeded to shoot down my idea. It all had to do with how I finessed the upper trend lines. And there's one reason why I call my commentaries Eddie's crayons, not Eddie's sharp pointed pencils. I was not happy about the situation, but it seemed to provide a solution as to what was a dominant pattern here at the end of 2021. And at the end of 2021, prices rose, pushing up through all the moving averages and all the resistances and downtrends, optimized or not. 2 years ago, I said the following, and I quote, "I feel obliged to detail potential points topside, just in case this move higher proves to be true. This gives a potential topside point in the 137 1/4 area. It's still a point, as I'm not certain as to whether the pattern will work through. We're after all still testing the area around any possible break. But that is what it looks like right now." End of quote. Well, by the end of February 2022, this point had become a target at 137 1/4. By the end of March 2022, the market had reached and passed through it, but only really by a small amount before coming back down. The drop was in 3 stages throughout the rest of 2022, through the 1 year moving average, currently 81.78, and the 2 year moving average, currently 90.93, and then the 3 year moving average, currently at 85.43. Then the 50% Fibonacci line of the 2020 to 2022 move at 77.60, until in March last year, prices halted at the combination of the broken upper trend line of the descending wedge pattern and then flatlining 5 year moving average, currently at 72.40, which is highlighted in gold on my monthly chart. This was a prolonged hesitation there until the June last year, when prices reverted back up, but they really didn't manage to move up that high, failing just over the 61.8% Fibonacci line of the big 2020 to 2022 move at 92.14. And closing just underneath the more recent 38.2% Fibonacci move of the 2020 to 2023 move. That's at 96.52. This limited reversion back up, followed by the subsequent move back down in the latter part of 2023, does not bode well for the bulls right now. The only thing, and it does look an interesting if not imposing thing right now, has been the performance of the 5 year moving average, which in December managed to halt the decline, yet again, though this time without the help of the broken upper trend line, which is significantly lower. Another thing to bear in mind has been the triple golden crosses made in 2022 of the 2 year moving average over the 3 year, the 2-year moving average of the 5-year, and the 3-year over the 5-year moving average. All these are bullish if lagging indicators. Looking further below, we have congestion based around the 38.2% Fibonacci line of the 2020 to 2023 move at 63.06. All in all, there seems to be some significant support stretching from the 50% Fibonacci line at 77.60 down to the 38.2% Fibonacci line of the 2020 to 2023 move at 63.06. I suppose it all now depends on what the market will do with the wide congestion area. If we see a hold and rise, we might easily see prices much higher than the high of 2022. If we fall, and we might well see the lower trend line of the descending wedge pattern being visited once again. I said last year, and I quote, "I'm not looking for a quick solution here. A period of consolidation and reflection by the market for 2023 would be reasonable. One has never accused this market of being reasonable. Just take a look at the ranges of 2020 to see what I mean." End of quote. Well, the market has been reasonable in consolidating in 2023 after all, and also experiencing a period of self-reflection. However, with the lower high in 2023 compared to 2022, I suspect the pressure will be building again throughout 2024 for another move. Early indications are for an attempt lower. Just watch that 5-year moving average and a broken upper trend line of the descending wedge pattern for better guidance. Thank you for watching and listening. This annual broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Topic and ADM Investor Services International Limited. And here comes the final bit.